imagine looking at like a giant split screen of the world right now.
Oh, yeah.
Right? So on one side of the screen, you have these massive physical cargo ships trapped in a geopolitical bottleneck. And they're completely upending global supply chains and quietly raising the price of, well, pretty much everything you buy.
Everything, yeah.
And then, on the exact opposite side of that same screen, there is this invisible, incredibly high-stakes war being fought with lines of code.
Right, the digital arms race.
Exactly, a digital arms race that is literally rewriting the rules of global finance and security as we speak. So, welcome to the Deep Dive. Today, our mission is to connect those dots for you.
And it is quite a stack of sources we have today.
It really is. We are going to explore a massive stack of sources from, geopolitical market analyses and raw consumer inflation data, all the way to some highly exclusive tech industry reports. We want to figure out how the massive physical friction happening across the globe is, directly tied to that invisible digital battleground.
It really is a fascinating juxtaposition when you look at these sources side by side. Yeah.
Because when you start layering the data, you realize that these seemingly disconnected events from, what you are forced to pay to check a bag at the airport this summer, to these secret meetings happening behind closed doors at the U.S. Treasury, they're heavily intertwined.
It's wild.
It is. They are basically two sides of the exact same economic coin.
Okay, let's unpack this because I want to start on the physical side of that split screen, specifically with the geopolitical tension in the Middle East.
Right.
Our sources are painting a picture of a massive chokehold on physical energy markets. And this isn't just some abstract Wall Street problem.
Oh, not at all.
This is directly spiking the cost of living for you, for me, for everyone listening.
Yeah, to really grasp the scale of the physical stress, we have to look at the Strait of Hormuz. For context, this is one of the world's most critical shipping arteries for oil.
Right.
And right now, there is a fragile U.S.-Iran ceasefire in place.
Which sounds like good news.
Right.
You would think so. You would think a ceasefire brings relief. But despite that agreement on paper, the actual flow of physical oil through the strait remains severely constrained.
Wow.
Moving massive physical cargo through a high-tension zone is slow, it's expensive, and it's incredibly risky.
And this is where the numbers in these reports start doing things that, honestly, they feel completely detached from reality.
Oh, absolutely.
We have this analysis from Morgan Stanley flagging what they call an unnatural disconnect.
Yes, the Brent crude data.
Right. They're looking at dated Brent crude, which is the actual physical oil, and it spiked to $144 a barrel.
Yep.
But then, if you look at IC Brent futures, they are hovering way down below $100.
Right.
So help me understand this. We have a ceasefire on paper. Why is the physical oil market flashing such extreme panic at 144? I mean, it feels like the market is pricing in a ghost.
It absolutely looks like a glitch in the matrix until you look at the mechanics of how oil is actually bought and sold. This disconnect perfectly exposes the difference between trading paper contracts and moving physical liquids. Those futures contracts that sub 100 number those trade on hope.
Just hope.
Literally. Investors are looking at a computer screen, they're seeing a ceasefire headline and betting that 6 months from now, things will be stable.
Right.
But dated Brent, that represents the harsh, unforgiving reality of physically pumping a barrel of oil onto a tanker and navigating it through a dangerous strait today. You cannot fuel a commercial jet or a delivery truck with a futures contract.
Right. You need the actual liquid in the tank right now.
Precisely. In the industry, they call this prompt supply, meaning the oil available for immediate delivery. And right now, prompt supplies are incredibly tight.
Wow.
JP Morgan just issued a stark warning that Brent crude could revisit that $120 mark across the board if full traffic through Hormuz doesn't resume by July.
Which is right around the corner.
Exactly. And it's not just shipping routes. You have reports of Saudi production setbacks from drone strikes, and that's keeping the physical market artificially squeezed.
Keys.
So the reality on the ground is entirely divorced from the optimism on the trading floor.
And the ripple effect of that physical tightness hits you, the consumer, almost immediately. We don't just feel it at the pump.
No, it's everywhere.
We're looking at U.S. inflation data that jumped 0.9% month over month and 3.3% year over year in March.
That's massive.
It is. That is the largest monthly rise we have seen in nearly 4 years. And the primary driver. a massive 21.2% spike in the cost of gasoline.
Which acts as a highly regressive tax.
Right.
When gasoline spikes over 20%, it disproportionately hurts everyday consumers because it just leaves them with significantly less disposable income for literally anything else.
You have to drive to work.
Right. The International Monetary Fund actually put out a warning about permanent scarring to global living standards from this kind of persistent energy shock.
Permanent scarring.
That's their word. When the baseline cost to move goods in power factories remains elevated, estimates from Goldman Sachs and JP Morgan point to slower overall job growth and a lasting drag on GDP. I mean, the math just doesn't work for rapid expansion.
And we are seeing that baseline cost absolutely hammer the travel industry right now.
Oh, the airlines are struggling.
Big time. Look at airlines, American, Delta, Southwest, United, JetBlue. They're all quietly or sometimes very loudly raising their checked bag fees.
Yeah.
They're specifically targeting those basic economy tickets just to offset the soaring jet fuel costs tied directly back to those Gulf disruptions.
And it's worse abroad.
Yeah, over in Europe, it's even more dire.
Yeah.
The Airports Council International Europe is warning of systemic physical jet fuel shortages in just 3 weeks if Hormuz remains constrained.
3 weeks.
You have carriers like Ryanair openly considering cutting flights entirely.
Because the physical supply chain is just profoundly delicate. When the fundamental price of moving an object from point A to point B skyrockets, it forces radical, immediate shifts in both how consumers spend their dwindling cash and how corporations try to survive the margin squeeze.
Which is exactly what I want to dig into next.
Okay.
Rising oil makes everything expensive, so how is that changing what we buy? I was looking at the electric vehicle market in our notes, and frankly, without those government subsidies propping things up, the landscape looks incredibly grim.
Very grim.
Total U.S. EV sales fell 27% year over year in the first quarter. Like, who is actually surviving this kind of consumer pullback?
It's a brutal shakeout. Tesla managed to hold on to a 54% market share, mostly due to the sheer volume strength of the Model Y, and Toyota actually saw some growth, though they are starting from a much smaller EV base.
Right, but what about the legacy guys?
Legacy automakers like Ford and Volkswagen saw steep, painful declines. The base costs of manufacturing these vehicles are simply too high for consumers who are dealing with massive inflation everywhere else in their lives.
But wait, if Western automakers are struggling this much to find buyers, what is happening in China? Aren't they like the biggest EV market in the world?
They are, and the dynamic there is incredibly telling. Chinese retail demand for new energy vehicles softened considerably.
Really?
Yeah, domestic sales fell 14.4% year over year in March. The domestic consumer there is feeling the pinch, too.
Okay, so they're slowing down.
But because their manufacturing base is so heavily subsidized and producing at such a massive scale, they can't just stop making cars. So what do? They export. Their EV exports skyrocketed 139.9%.
Wow. So their own people stop buying and they just flood the global market with cheaper cars.
Exactly. Which puts immense existential pressure on those Western automakers who are already bleeding cash and dealing with high operational costs.
Right.
But it's crucial to understand, this margin squeeze isn't just an auto industry problem. It is hitting the core of American logistics.
Yeah, like the post office.
Take the U.S. Postal Service. They are facing such a severe structural liquidity crunch that they are proposing raising the first-class stamp from 78 cents to 82 cents this July.
And it goes way deeper than stamps, too.
It really does.
The USPS is actually suspending their employer FERS pension contributions.
Yeah, that's huge.
For anyone not familiar, FERS is the Federal Employees Retirement System. When a massive federal entity stops paying into its employees' retirement funds just to preserve daily cash flow, that is a glaring red flag.
A massive red flag.
They're warning they could run out of money entirely by early 2027 if they don't get relief.
And if the USPS falters, that pushes massive volume and pressure onto private shippers like UPS and FedEx, who are, also dealing with those exact same fuel spikes we talked about earlier.
Everything is connected.
Exactly. The entire logistics network becomes fragile.
It's honestly like consumers and corporations are both playing a massive high-stakes game of musical chairs with their budgets.
That's a great way to put it.
And the music is slowing down fast. I mean, when the post office is essentially checking the couch cushions for spare change and suspending pensions, the squeeze is real.
It's the perfect analogy. When foundational costs rise, the pressure violently moves up the chain. Companies are desperately hunting for revenue anywhere they can find it.
Yeah,
We see it in digital services. Alphabet's YouTube just hiked U.S. rates for premium and music by $1 to $4 a month.
I saw that.
We see it in high-end luxury goods. Dolce & Gabbana's co-founder and chairman stepped down while the company scrambles to negotiate about 450 million euros in debt refinancing. LVMH is facing similar headwinds.
Yeah, even the luxury brands.
Even household furniture stocks like Hooker Furnishings and Flex Steel are taking a beating. They're forced to lean entirely on aggressive cost-cutting just to survive weak housing turnover and cautious consumers.
And as the financial pressure mounts, so does the brand pressure.
Oh, yeah.
Every single corporate move is hyper-scrutinized right now. There is zero margin for error. Look at Phil's Coffee in the Bay Area. In an effort to standardize their store decor, which, is a very common operational move to streamline costs, they announced plans to remove Pride and other flags from their locations.
And the pushback was immediate.
Immediate and intense. They faced significant backlash from local LGBTQ+ leaders and customers, even though corporate stated their support for the community hadn't changed.
Right.
And just to be super clear to everyone listening, we are completely impartial here. We're not taking a side on this issue at all.
Of course not.
We're simply looking at the source material, and it is a fascinating look at the absolute tightrope retailers are walking right now. You try to standardize operations to save a few pennies in a high-pressure economy, and you inadvertently walk right into a localized brand crisis.
It's very tricky.
It's very similar to the intense social and operational pressures we've watched Starbucks navigate recently.
It all comes down to defensive posturing. In a booming economy, companies have the luxury of taking risks, absorbing higher costs, or maintaining unique, localized store models.
Sure.
But when inflation bites, energy costs soar, and consumer sentiment drops to an all-time low of 47.6, survival instincts kick in. Every decision, whether it's a pricing hike, a debt restructuring, or literally standardizing the paint on the walls, becomes a critical defensive maneuver.
Okay, so we have traditional companies and everyday consumers pinching pennies and terrified of making a wrong move.
Right.
But let's flip back to the other side of our split screen. Because if we look at big tech right now, they are operating in an entirely different financial universe.
Oh, entirely different.
They aren't checking couch cushions. They are writing blank checks to build out digital infrastructure for artificial intelligence.
The scale of the capital being deployed is genuinely staggering. It is a true textbook digital gold rush.
A gold rush.
Look at Taiwan Semiconductor Manufacturing, TSMC. They just posted a record first quarter, with revenue up 35%, driven almost entirely by the relentless demand for AI chips.
Wow.
Micron is riding what they're calling an AI memory supercycle. They produce something called high bandwidth memory, or HBM.
And just to clarify, high bandwidth memory is basically the super fast, specialized memory that these massive AI processors need in order to think and process data at lightning speeds, right?
Exactly. Without it, the AI creates a bottleneck. And the demand for it is insatiable right now, largely tied to NVIDIA's platforms.
Unbelievable.
This infrastructure build-out is single-handedly driving the broader market. The NASDAQ hit record highs fueled almost entirely by semiconductor companies like NVIDIA, Broadcom, and Marvell. Bank of America even lifted its 2026 semiconductor revenue outlook to a mind-blowing $1.3 trillion.
Which creates a completely bizarre labor dynamic.
Oh, yeah.
We talked earlier about companies cutting costs to survive. Over in tech, the government just implemented a new $100,000 fee on many H-1B visa applications for foreign talent.
Right.
That fee is so steep that Walmart cut their certified filings by more than half. Even massive players like Amazon, Alphabet, Meta, and Microsoft curtailed their visa usage to save money.
But NVIDIA
actually increased their filings. They're moving so fast and generating so much cash that dropping 6 figures on a single visa fee is just the cost of doing business.
It is the ultimate flex of corporate power.
Totally.
But here is the critical distinction we have to make. The cash is not flowing evenly across the tech sector.
Okay, what do you mean?
Well, while the hardware companies, the ones building the physical chips, are printing money, the software companies trying to build the actual AI applications are facing serious, punishing friction from Wall Street.
Yes, and this is where I get really confused. Microsoft is the poster child for AI software right now. Everyone agrees AI is the inevitable future. But Microsoft shares are down over 20% year to date. Why are they being punished by investors for investing in the exact thing everyone says is the future? Is the AI honeymoon already over?
The honeymoon isn't over, but the market is ruthlessly separating the picks and shovels from the gold miners.
Ah,
In the 1849 gold rush, the people who got rich first and with the least risk were the ones selling the picks and shovels.
right.
Right now, NVIDIA, TSMC, Broadcom, and infrastructure companies like CoreWeave, which just saw its stock pop 10% after announcing a massive data center pact with Anthropic, they're selling the shovels.
Okay.
They're providing the essential hardware everyone needs just to participate in the race. They make immediate, guaranteed cash.
Because you can't even play the game without their chips.
Exactly. But software companies like Microsoft are the gold miners. They are taking on massive execution risk. Microsoft just dropped a staggering $37.5 billion on capital expenditures in a single quarter.
$37 billion in a quarter. Right.
They bought $37.5 billion worth of shovels. Now they actually have to strike gold. They are sitting at a valuation of around 22 times their projected 2026 earnings.
Meaning investors are paying a massive premium today, expecting Microsoft to generate huge, unprecedented profits a few years down the road.
Right. It's what analysts call earnings leverage. Investors are looking at that huge spend and saying, okay, you built the infrastructure. Now prove to us you can convince millions of consumers and businesses to pay a monthly subscription for Copilot or Azure AI to justify that cost.
Prove it.
Exactly. The hardware guys already got paid. The software guys have to prove their business model actually works, and investors are getting impatient.
And while the market argues about subscriptions and monetization, the underlying technology itself is advancing at a terrifying speed.
Very terrifying.
Which brings us to the final and frankly most alarming part of our deep dive today. This massive trillion-dollar investment in AI isn't just giving us smarter chatbots. It is fundamentally breaking the foundations of traditional cybersecurity.
The paradigm shift here cannot be overstated.
Tell me about it.
Our sources detail a report regarding an unreleased AI model from Anthropic, known as the Claude Mythos Preview. According to the internal findings, this model possesses what they call unprecedented vulnerability finding capabilities.
Unprecedented vulnerability finding. So they basically build a digital lockpick.
Pretty much.
But I'm struggling to see how this is different from normal hacking. Is the AI just guessing passwords millions of times a second? How does an AI find a vulnerability that human cybersecurity experts miss?
It's not about guessing passwords. It's about structural comprehension.
Okay.
Traditional cybersecurity is mostly rules-based. Human engineers look for known flaws or specific types of malicious code. But an AI like Mythos can read millions of lines of complex legacy code in seconds. It doesn't just look for known rules. It recognizes invisible structural patterns and logical flaws that a human brain simply cannot process at scale. It can see how a piece of code written in 1998 interacts with an update from 2024 to create a backdoor no one even knew existed.
Which completely explains the panic in Washington.
Oh, absolutely.
The U.S. Treasury was so terrified by the implications of this AI that they summoned major bank chiefs. We are talking the heads of Goldman Sachs, Bank of America, Citi, Morgan Stanley, and Wells Fargo, all pulled into a single room for an emergency briefing on AI cyber risks.
Think about what that means. When the U.S. Treasury summons the 5 largest banks in the country to discuss a single piece of unreleased technology, the entire threat matrix has shifted.
It's a huge deal.
Global finance runs on incredibly old, patched-together legacy code. If an AI can spot vulnerabilities faster than human engineers can even comprehend them, the entire financial system is sitting exposed.
And the corporate reaction to this threat is totally unprecedented.
Yeah.
Anthropic launched something called Project Glasswing. They are taking this Mythos model and enlisting the biggest, most fiercely competitive tech giants in the world to use defensively. You have Amazon, Apple, Microsoft, Broadcom, Cisco, and JP Morgan companies that normally fight tooth and nail for market share, all teaming up to use Mythos to proactively scan their own networks to find and fix software flaws before bad actors can exploit them.
It is a profound, almost poetic irony.
Isn't it?
Big tech is spending billions upon billions of dollars to aggressively develop this exact technology, and now they are so frightened by its capabilities that they have to form a massive cross-industry alliance just to defend against it. Because AI's unparalleled pattern recognition makes it both the ultimate weapon to break a system and the ultimate shield to defend it.
So where does this leave traditional cybersecurity companies? I mean, we saw stocks for huge established security names like Cloudflare, Okta, and CrowdStrike wobble heavily when this news broke.
Because the entire nature of the cat and mouse game is changing.
Right.
For decades, cybersecurity has been human hackers trying to outsmart human defenders using firewalls. But if the attackers start using AI models to invent entirely new ways to breach a system, a traditional software firewall is functionally obsolete. The only way to fight an AI is with another AI.
And this incredible digital tension is bleeding straight out into the physical world.
It is.
The stakes of who controls this technology are so high that it is manifesting as a real-world physical danger. We saw the recent report of a 20-year-old suspect being arrested after igniting an incendiary device at the gate of OpenAI CEO Sam Altman's home in San Francisco.
Just crazy.
The same individual later threatened the company's headquarters. Microsoft-backed OpenAI said operations remained secure and no one was injured. But it's a glaring reminder of how volatile this space has become. It's not just lines of code anymore, it's physical security.
And that reality brings our entire discussion full circle.
Yeah.
The physical systems that govern our daily lives and the invisible digital systems that govern our future are both under immense concurrent stress.
So what does this all mean for you listening right now? We started by looking at a split screen.
Right.
On the physical side, geopolitical friction in the Strait of Hormuz is creating real-world consequences. It's driving up your grocery bill, hiking the cost of your summer flight bag fees, and dragging consumer sentiment to historic lows.
Yep.
On the digital side, an unprecedented hardware boom is funding artificial intelligence so powerful it is triggering emergency cyber panics at the highest levels of the U.S. Treasury. And it all trickles down to your daily life. We saw a brief glimmer of relief recently when mortgage rates dropped to 6.37% after the U.S.-Iran ceasefire headline hit.
But as real estate analysts at Zillow quickly cautioned, with Treasury yields remaining highly volatile and physical oil prices still flashing those $144 stress signs, any relief for everyday consumers or home buyers might be incredibly short-lived.
The volatility is the only constant across both screens.
It really is. Which leaves us with a critical underlying question about where this digital arms race is ultimately heading.
What's that?
Well, if AI models like Mythos become the absolute gold standard for finding vulnerabilities, and human engineers have to rely entirely on AI alliances like Project Glasswing to defend against other rogue AIs,
Yeah.
what happens when human oversight can no longer comprehend the digital battles being fought over our financial data?
Oh, wow.
Are we rapidly accelerating toward a future where global cybersecurity is a fully automated, invisible war one, where the lockpicks and the vault doors are both hallucinated by machines, and we just have to hope the math works out in our favor?
It's an incredibly heavy thought to leave you with, but as that split screen of our world continues to merge into one chaotic picture, it's reality we are all going to have to face. Thanks for joining us on this deep dive. Stay curious, keep questioning the world around you, and we'll catch you next time.